Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company Chegg, a company that, well, has helped me a lot when I was in college because they have like all the answers for like all the homework and all that stuff. So they really did help me out when I was in college, and seeing that of course their earnings are coming out as of May 2nd. I want to see if this company's fundamentals actually match the current share price. So with that said, let's get started with this analysis. We're going to jump right into the calculator, guys. Chegg does not pay out a dividend, so we're going to just analyze the numbers. Ticker symbol of CHGG, market cap of $3 billion, PE guys of NA. Now, if you guys saw my Tesla video, you guys probably know that I actually fixed the calculator in order to fix the issue that we cannot analyze companies when they have NA as a PE, and also companies that have negative cash flow as well. Now we can actually do that. So, seeing that their PE is NA, this means that their earnings are non-existent. And at the current share price of $24.74, yeah, we might actually not know if this is a good price or not, but let's use discounted free cash flow to see if we can actually figure this out. They do not pay out a dividend, which means that their $81 million in 5-year average free cash flow is going into themselves to pay back their debt, to make acquisitions, and to reinvest in their own company. Coming over here to the fundamentals, guys, starting off with a net income 5 years ago of negative $20.3 million to 1 year ago of negative, I can't even get up there, negative $1.5 million. That is an increase of 93%. However, if you guys are looking at this graph, yeah, it is an increase, but yet their entire net income is still in the red. Oh dear Lord, this is very, very bad. So increase of 93%, even so, the income is still in the red every single year within the past 5 years. Now coming into the cash flow, this is the lifeblood of the company. Cash from operations less your capital expenditures. 5 years ago of $25.5 million to 1 year ago of $168.1 million. That is an increase of 559% with an average 5-year free cash flow of $81.02 million. Now, this is significantly looking better than that of their net income. It almost looks like the complete opposite, actually. At least this one is slightly going up. Actually, not even slightly. It is increasing year over year, which is actually really, really good to see. And it's also very, very consistent as well. And now looking at the revenue, we got 5 years ago of $255 million to 1 year ago of $776.3 million. That's an increase of 204.31%. And very, very similar to the cash flow, it is a very nice steady increase within the past 5 years. Coming now to the total assets minus the total liabilities. If they were to liquidate all of their assets, would they be able to cover their liabilities for starters? And two, how much money would they have after doing so? As you guys can see right here, currently, if they were to do this, they would still be left with, guys, $1.1 billion in total assets minus total liabilities. And not only that, for their credit as well, they have been positive and increasing their total assets every single year within the past 5 years as well. Average total assets is around $1.8 billion. Average liabilities is around $1.1 billion. Doing the average assets minus the average liabilities, we get $687.32 million. Now, looking at the shares outstanding, this one was a really, really big indicator that this is not that good of a company, solely because of the fact that they are diluting you as the investor. The more this number goes up, the less piece of the company you have, meaning you are being diluted. So as you guys can see right here, 5 years ago of 109.7 million shares to today, guys, of 137 million shares. This is an increase of almost 25% at 24.89%. And from the previous year to the current year, this is from 2 years ago to 1 year ago, they increased it almost 6%. So as it stands, guys, this is a massive, massive increase. They are diluting you to no end. This is not like, oh, our stock price is high, let's just issue a couple shares instead of taking on debt. No, this is straight up dilution. And lastly, looking at the cash and equivalents, they currently have $854.1 million in cash and equivalents with an average cash of $512.8 million. Now let's make some assumptions. Low, median, high. As always, 3 different factors: revenue growth, predicted share buyback, and the required rate of return. Revenue growth, guys, I'm going to use Seeking Alpha's growth tab, looking at the revenue growth year over year and the revenue growth forward, and making an assumption between those two numbers, or at least try to be conservative with my own assumption. For the predicted share buyback, I'm going to use the shares outstanding graph that we just saw. And for the required rate of return, keep it flat 10% to match the S&P 500 on the best years. Now, for my lowest assumption, let's say a growth of 5%, predicted share buyback of -17. This means that the company will continue to issue shares at -17% within the next 4 years. And in doing so, we get the target share price of $12.89. For my immediate assumption, let's say a growth of 7%, predicted share buyback of -14%. This comes out to be $14.20. And lastly, for my highest assumption, a growth of 8%, predicted share buyback of -11%. This comes out to be $15.12. Now adjusting for debt, the way we do this is we take the net debt and the cash equivalents and we add them. If a company has more debt than cash, this number comes down, and if the company has more cash than debt, then this number comes up. And as you can see right here, for my lowest assumption, they actually come up to $17.24. For my immediate assumption, it is $18.68, and for my highest assumption, it is $19.73. Now, me personally, I like to add a margin of safety, 5, 10, and 15%, because you don't want to overpay for something. The more you overpay for something today, the less returns you're going to have in the future. And every investment is also the present value of all future cash flow, so you want to be as conservative as possible and not overpay for a company today. In doing so, adding this margin of safety for the low assumption, I would personally like to buy between $14.65 to $16.37. For my immediate assumption, I would like between $15.87 to $17.74, and for my highest assumption, I would be at $16.77 to $18.74. As it stands with the current share price of $24.74, this is a little bit expensive as it stands. However, as I always say in every single video, these are just my assumptions. You could change these numbers and make it so that it actually falls in line. For example, let's say that we think that their revenue growth in the highest assumption will grow at 12%. Well, we're almost there in accordance to the target share price adjusting for debt. And let's say that you think that they're going to issue shares at -5%, then we are essentially there at the current share price at $23.19 for the target share price adjusting for debt. So as you see, it really just depends as to where you guys think these numbers would be placed at. So because this is all based off of assumptions, I have this calculator, guys, available for free. It's available in my calculator playlist. There's videos on how to use this calculator and also how to use my book value calculator as well, with links in the description as to where you can make yourself a copy. So I highly suggest you go to my playlist, you see those videos and see how it actually works, and you get this calculator and you make your own assumptions. I also have a dividend tracking sheet as well, and a video on how to set it up. Hopefully it is somewhat easy. It's a little bit complicated, but nonetheless, you still should be able to do it if you follow along. And for these 3 free things, guys, all I'm asking for in return is like, subscribe, comment, help me grow my channel. That's literally it. 30 seconds of your time to hit that bell, hit that like, and of course, share. Really all I'm asking for. 3 free things. Just help me grow my channel. Thank you so much for the 550 subscribers. Absolutely love all of you guys. Would love to get to 1,000 by the end of the year. That would be a great milestone. All in all, guys, when it comes to Chegg, this is actually a company, as I said, that I used a lot when I was in college, right? I mean, let's face it, I didn't really do homework. I kind of just copied it from Chegg. But yeah, this is a company that really does help a lot of students. But in my personal opinion, when it comes to their fundamentals, yeah, they really have a long way to go, right? I mean, that net income is awful, absolutely awful. And sure, their revenues and cash flow is actually doing really good. But man, that net income and the shares outstanding are also really bad. You are being diluted. And also the fact that they do not pay a dividend, yeah, this to me just isn't in my ballpark. That pretty much does it for this video. Like if you like, comment, subscribe. As always, you guys can follow me on my new tech sites of BitChute, Odyssey, and Rumble. I also have a Let's Play channel, link in the description below. Currently playing through Sonic Unleashed, so if you want to see that, you can follow me there too. With that said, peace out, and be on the lookout for the next stock analysis of video.